Did your favorite clothing brand just disappear overnight? From mall staples to fashion powerhouses, 15 once iconic brands are shutting down for good, and some of these might shock you. Whether it's bankruptcies, failed rebrands, or just straight-up bad business decisions, these companies couldn't keep up with the ever-changing world of fashion. Is your go-to brand on the chopping block? Stick around because we're diving deep into the rise and fall of these once-beloved retailers, and trust me, some of these stories will leave you shook. Let's start with number 1. Banana Republic, once a beacon of upscale casual wear, has faced significant challenges in recent years. In October 2020, Gap Inc., the parent company, announced plans to close approximately 350 Gap and Banana Republic stores across North America by the end of 2023, aiming for a smaller and healthier fleet of stores. The brand's journey began in 1978 as the Banana Republic Travel and Safari Clothing Company, capturing imaginations with its safari-themed apparel. Gap Inc. acquired it in 1983, rebranding it to appeal to a more upscale market. However, the retail landscape's evolution, especially the surge in online shopping, posed challenges. The COVID-19 pandemic further accelerated these issues, leading to the closure of numerous stores. In 2017, Gap Inc. operated over 700 Banana Republic locations worldwide. However, by late 2022, the number of US stores had declined to 379, reflecting a significant contraction. This downsizing underscores the brand's struggle to adapt to shifting consumer preferences and the increasing dominance of e-commerce. Despite these challenges, Banana Republic has made efforts to reinvent itself. In 2023, the brand collaborated with New York-based fashion designer Peter Du to produce a fall/winter capsule collection, signaling a bid to regain relevance in the competitive fashion industry. The brand's contraction is part of a broader trend affecting many retailers. Gap Inc. has been adjusting its store fleet, closing underperforming locations while focusing on more profitable ventures. This strategy reflects the company's efforts to navigate the rapidly changing retail environment. 2. Express, once a staple in malls across America, has faced many challenges in recent years. The brand, known for its trendy apparel, has struggled to keep up with the rapidly changing retail landscape. In April 2024, Express filed for Chapter 11 bankruptcy protection, citing declining sales and rising operational costs. The company announced plans to close over 100 stores, including all 10 locations of its sister brand, Up West. This move was part of a broader strategy to restructure and stabilize its financial position. The challenges faced by Express are not unique. The retail industry has been undergoing a significant transformation, with many traditional brick-and-mortar stores struggling to compete with online retailers. Factors such as rising interest rates, inflation, and shifts in consumer spending have contributed to a wave of bankruptcies in the sector. Despite these setbacks, Express has shown resilience. In June 2024, a joint venture led by WHP Global, Simon Property Group, and Brookfield Properties acquired Express's operations, providing a lifeline for the brand. This acquisition aimed to revitalize Express and adapt its business model to the evolving retail environment. 3. Victoria's Secret. Victoria's Secret, once synonymous with glamorous fashion shows and the iconic Angels, has experienced a significant transformation in recent years. In 2021, the brand acknowledged the need for change, moving away from its traditional image to embrace diversity and inclusivity. This shift aimed to resonate with a broader audience, reflecting evolving societal values. The rebranding efforts included the introduction of the VS Collective, featuring accomplished women such as soccer star Megan Rapinoe and actor Priyanka Chopra Jonas. This initiative marked a departure from the brand's previous focus, highlighting achievements over appearances. In 2023, Victoria's Secret appointed Hilary Super, former leader of Savage X Fenty, as CEO. This strategic move signaled the brand's commitment to reinventing itself in a competitive market. The journey of Victoria's Secret illustrates the challenges and opportunities that come with redefining a brand in today's dynamic retail landscape. By embracing inclusivity and diversity, the company aims to align with contemporary values and consumer expectations. 4. J. Crew, once the epitome of preppy fashion, has experienced a tumultuous journey in recent years. The brand's struggles culminated in May 2020 when it became the first major U.S. retailer to file for Chapter 11 bankruptcy amid the COVID-19 pandemic. The company's financial woes were not solely due to the pandemic. J.Crew had been grappling with mounting debt and declining sales for several years. In 2017, the retailer attempted to ease its heavy debt load as sales continued to decline, marking the 11th consecutive quarter of same-store sales drops. Despite these challenges, J.Crew managed to navigate through bankruptcy proceedings. By September 2020, the company won approval to exit Chapter 11 bankruptcy, with lenders agreeing to swap about $1.6 billion in debt for equity in the reorganized business. The rise and fall of J.Crew serve as a cautionary tale for retailers. Once a beloved brand, J.Crew struggles highlight the importance of adapting to changing consumer preferences and the challenges of managing substantial debt in a rapidly evolving retail landscape. 5. Dress Barn, established in 1962 by Rosalind Yaffa in Stamford, Connecticut, began as a women's clothing retailer catering to working women. Over the decades, it expanded significantly, becoming a familiar name in shopping centers nationwide. However, by 2019, Dress Barn faced mounting challenges. The rise of e-commerce, shifting consumer preferences, and increased competition from fast fashion brands led to declining sales. In May 2019, Ascena Retail Group, Dress Barn's parent company, announced the closure of all 650 Dress Barn stores, marking the end of its physical retail presence. Despite the shutdown of its brick-and-mortar stores, Dress Barn found a new lease on life online. In 2020, Retail E-commerce Ventures acquired the brand, transitioning Dress Barn into a digital-only retailer. This move allowed the brand to continue serving its loyal customer base without the overhead costs associated with physical stores. The transition appeared successful. By September 2020, Dress Barn's online sales were reportedly growing at a rate exceeding 100% per quarter, indicating a positive reception from consumers. 6. Forever 21. Remember when Forever 21 was the go-to spot for trendy outfits that didn't break the bank? Founded in 1984, this fast fashion retailer quickly became a staple in malls worldwide, catering to fashion-forward shoppers seeking the latest styles at affordable prices. However, in recent years, Forever 21 has faced significant challenges, leading to store closures and financial restructuring. In 2019, Forever 21 filed for Chapter 11 bankruptcy, citing factors such as overexpansion and the growing shift towards online shopping. The company closed numerous stores and attempted to restructure its operations to regain stability. Despite these efforts, the retailer continued to face financial difficulties. In February 2025, reports emerged that Forever 21 was working with restructuring firm BRG to evaluate options, including selling off profitable leases, to avoid a second bankruptcy filing. Subsequently, the company began liquidating 215 of its locations, with closures expected to be completed by April 2025. The rise of online competitors like Shein and Temu has intensified the challenges for traditional retailers like Forever 21. These digital native brands offer similar trendy styles at competitive prices, attracting the same demographic that once flocked to Forever 21 stores. In response, Forever 21 has attempted to adapt by enhancing its online presence and exploring collaborations to stay relevant in the fast-paced fashion industry. 7. Men's Wearhouse. Remember the days when suiting up was the norm, and Men's Wearhouse was the go-to destination for all things formal. Founded in 1973 by George Zimmer, the brand became synonymous with affordable suits and the memorable slogan, "You're going to like the way you look." However, the tides of fashion and consumer behavior have shifted dramatically over the years, leading to significant challenges for the retailer. In 2013, the company made headlines by ousting its founder, a move that surprised many loyal customers. This decision marked the beginning of a series of strategic changes, including a merger with Joss. A bank in 2014. While the merger aimed to consolidate the men's formalwear market, it also saddled the company with substantial debt. The rise of e-commerce and a shift towards casual work attire further impacted Men's Wearhouse. The COVID-19 pandemic exacerbated these challenges, with a significant drop in demand for formal clothing as remote work became widespread. In response, Tailored Brands, the parent company of Men's Wearhouse, announced plans in 2020 to close up to 500 stores and reduce its corporate workforce by 20%. Despite these hurdles, Men's Wearhouse has been working to adapt to the evolving retail landscape. Efforts include enhancing their online presence and exploring new product lines that cater to more casual and versatile fashion needs. The journey of Men's Warehouse reflects the broader challenges faced by traditional retailers in staying relevant amidst changing consumer preferences and market dynamics. 8. H&M, the Swedish fashion powerhouse, has long been a go-to for trendy, affordable clothing. However, even giants stumble, and H&M is no exception. In 2020, H&M began re-evaluating its global presence, leading to the closure of approximately 170 stores. The following year, in 2021, the company shuttered an additional 250 locations, reducing its footprint from over 5,000 stores worldwide. Financially, H&M has experienced fluctuations. In the third quarter of fiscal year 2024, the company reported a 3% decline in net sales, totaling 59.01 billion Swedish krona, approximately $5.8 billion, down from 60.89 billion Swedish krona in the same period the previous year. Additionally, H&M's Monki brand announced the closure of its Birmingham store on March 9, 2025, as part of a broader strategy to integrate Monki with another H&M brand, Weekday. Despite these challenges, H&M remains committed to adapting to the evolving retail landscape. The company plans to invest more in physical stores, including refurbishments and upgrades, and is set to open its first store in Brazil in 2025. 9. American Eagle Outfitters, AEO, once a staple in malls across North America, has been navigating the shifting tides of retail with a strategic pivot towards digital channels and a re-evaluation of its physical store footprint. In 2020, AEO announced plans to permanently close 40 to 50 stores, with an additional 500 locations under review for potential closure as leases expired over the subsequent 2 years. The closures primarily targeted mall-based American Eagle stores, reflecting a broader trend of declining mall traffic and changing consumer shopping habits. By January 2021, the company outlined further plans to shutter 200 to 250 of its 880 American Eagle locations in the US and Canada over a 2 to 3 year period. Concurrently, AEO focused on expanding its Aerie brand, aiming to open 50 new storefronts in 2021 and projecting the total to reach approximately 400 by year-end. The company set an ambitious goal for Aerie to operate between 500 to 600 stores by 2023, with revenue expected to double to $2 billion, positioning Aerie as the primary growth driver for the organization. The COVID-19 pandemic further accelerated these changes, with AEO experiencing a 15% decline in net revenue to $884 million during the second quarter of 2020, primarily due to pandemic-related store closures. While Aerie's revenue rose by 32%, the American Eagle brand saw a 26% decline, highlighting the contrasting performance between the two segments. In early 2025, American Eagle joined other major retailers in exiting certain markets, notably closing its location in San Francisco's Westfield Center Mall. This departure contributed to a vacancy rate exceeding 50% in the once thriving shopping center, reflecting broader challenges faced by brick-and-mortar retailers in urban areas grappling with rising crime and shifting consumer behaviors. 10. Brooks Brothers, established in 1818, holds the title of America's oldest clothing retailer, renowned for its classic and sophisticated attire. However, even icons face challenges. In July 2020, the company filed for Chapter 11 bankruptcy, primarily due to the economic impact of the COVID-19 pandemic. This led to the closure of 51 out of its 250 North American stores, including the flagship Madison Avenue location. In September 2020, a joint venture between Authentic Brands Group and Simon Property Group acquired Brooks Brothers, committing to operate at least 125 retail locations in the US. Despite these efforts, the brand faced further challenges. In April 2024, Ted Baker Canada, the operator of Brooks Brothers stores in Canada, filed for creditor protection, leading to the closure of all Canadian stores. In a strategic move to strengthen its position, Brooks Brothers' parent company, Spark Group, merged with J.C. Penney in early 2025 to form Catalyst Brands. This new entity encompasses over 1,800 stores and 60,000 employees, aiming to leverage the strengths of both brands to navigate the evolving retail landscape. 11. Lucky Brand. Remember when Lucky Brand jeans were the epitome of cool, effortlessly blending vintage vibes with modern style? Founded in 1990 by Gene Montesano and Barry Pearlman, Lucky brand quickly became a staple for denim enthusiasts seeking that perfect, lived-in look. Their signature four-leaf clover emblem and the cheeky, Lucky U, stitched inside the fly became iconic touches that set him apart in the crowded denim market. However, as the retail landscape shifted, so did Lucky brand's fortunes. In July 2020, amidst the economic upheaval caused by the COVID-19 pandemic, the company filed for Chapter 11 bankruptcy. This move led to the closure of numerous brick-and-mortar stores, marking a significant retreat from the physical retail space. The brand was subsequently acquired by Authentic Brands Group, a company known for revitalizing distressed retailers. The challenges didn't stop there. In April 2024, Ted Baker Canada, the operator of Lucky brand stores in Canada, filed for creditor protection, leading to the closure of all Canadian locations. This development underscored the brand's struggle to maintain its physical presence in an increasingly digital shopping environment. Recognizing the need to adapt, Lucky brand shifted its focus towards online retail and strategic partnerships. The brand's parent company, Spark Group, merged with J.C. Penney in early 2025 to form Catalyst Brands, aiming to leverage combined resources to navigate the evolving retail landscape. This merger reflects a broader trend in the industry, where traditional retailers are consolidating to strengthen their positions in the face of e-commerce giants. 12. Francesca's. Remember when strolling through the mall meant discovering that charming boutique with eclectic jewelry, trendy dresses, and quirky gifts? That was Francesca's, a haven for unique finds since its inception in 1999. Founded by siblings Chong Yi, Kyong Gil, In-suk Koo, and their close friend John DeMeritt, the first store opened in Houston, Texas, quickly capturing the hearts of shoppers seeking distinctive styles. Fast forward to the 2010s, and the retail landscape began shifting. Francesca's, once a mall darling, faced challenges as consumer preferences evolved and online shopping gained momentum. By 2019, the company grappled with declining sales and announced plans to close at least 30 stores to stabilize operations. The onset of the COVID-19 pandemic in 2020 exacerbated these challenges. Temporary store closures and reduced foot traffic led Francesca's to file for Chapter 11 bankruptcy in December 2020. The restructuring plan included closing 275 stores to streamline operations and focus on a more sustainable business model. However, this wasn't the end of Francesca's story. In January 2021, Terramar Capital LLC acquired the brand, committing to keeping at least 275 stores open and preserving jobs. This acquisition marked a turning point, allowing Francesca's to emerge from bankruptcy with a renewed vision. Embracing the changing retail environment, Francesca's launched Frankie by Francesca's in late 2021, a tween-focused line catering to younger fashion enthusiasts. By April 2023, the brand expanded this line to include Frankie Sport, offering activewear for ages 7 to 14. Additionally, in February 2023, Francesca's partnered with thredUP to introduce Forever Francesca's, a resale platform promoting sustainability by allowing customers to buy and sell pre-loved items. In May 2023, further diversifying its portfolio, Francesca's acquired lifestyle brand Richapora, known for its comfortable basics and loungewear. As of October 2024, Francesca's operates over 450 stores under both the Francesca's and Frankie by Francesca's banners, showcasing its resilience and adaptability in a competitive market. 13. Chico's and White House Black Market. Remember when Chico's was the go-to boutique for vibrant prints and unique jewelry, and White House Black Market epitomized the elegance of monochrome fashion. These sister brands, under the umbrella of Chico's FAS, have been staples in women's retail for decades. Founded in 1983 on Sanibel Island, Florida, Chico's started as a small store selling Mexican folk art and apparel. Over the years, it evolved into a national brand known for its distinctive sizing and bold styles. White House Black Market, established in 1985, began as a boutique specializing in women's clothing in shades of white and black, later expanding its palette but maintaining its chic aesthetic. However, the retail landscape has been anything but static. The rise of e-commerce, changing consumer preferences, and unforeseen global events have posed significant challenges. In 2020, the COVID-19 pandemic dealt a heavy blow to brick-and-mortar retailers. Chico's FAS wasn't spared. The company faced store closures and a sharp decline in foot traffic. By July 2020, Chico's Canadian subsidiary filed for bankruptcy, leading to the closure of all Canadian stores. In response to these challenges, Chico's FAS implemented strategic measures to adapt to the evolving market. The company enhanced its online presence, recognizing the growing importance of e-commerce. They also focused on optimizing their store footprint, ensuring that remaining locations provided personalized shopping experiences to loyal customers. These efforts aim to balance the convenience of online shopping with the tactile experience of in-store visits. 14. Lord & Taylor. Imagine a time when shopping wasn't just about clicking buttons but an event, a stroll through grand halls adorned with the latest fashions. For nearly 2 centuries, Lord & Taylor embodied this experience, standing as America's oldest department store since its establishment in 1826. Known for its elegant merchandise and iconic Fifth Avenue flagship store in New York City, it was a symbol of retail luxury. However, the retail landscape is ever-changing, and even giants can stumble. In August 2019, in an unexpected move, Lord & Taylor was sold to La Tote, a clothing rental startup, for $100 million. This acquisition aimed to blend traditional retail with modern rental services, hoping to rejuvenate the brand's appeal. But the timing couldn't have been worse. The COVID-19 pandemic struck in early 2020, leading to widespread store closures and a significant drop in consumer spending. By August 2020, Lord & Taylor filed for Chapter 11 bankruptcy, marking a pivotal moment in its long history. The initial plan was to keep some stores open, but as the pandemic's impact deepened, it became clear that survival was untenable. In August 2020, Lord & Taylor announced it would liquidate all its stores, signaling the end of an era. The once bustling aisles, filled with shoppers seeking the latest trends, became echoes of retail history. Yet, in the world of business, endings often lead to new beginnings. In October 2020, Sadia Group acquired Lord & Taylor's intellectual property, aiming to transform it into a digital-first retailer. By April 2021, the brand relaunched online, attempting to merge its rich legacy with the convenience of modern e-commerce. While the physical stores are no more, Lord & Taylor's name endures in the digital realm, striving to capture the essence of its storied past while adapting to contemporary shopping habits. 15. Topshop. Remember when a trip to Topshop was the epitome of high street fashion? With its flagship store on London's Oxford Street, Topshop was the go-to destination for trendsetters, offering a mix of chic clothing, shoes, and accessories. Established in 1964 as a youth brand within the Peter Robinson department store, Topshop quickly evolved into a standalone fashion powerhouse, boasting over 500 shops across 58 countries at its peak. However, the late 2010s brought turbulent times. The rise of e-commerce, coupled with increased competition and changing consumer behaviors, challenged traditional brick-and-mortar retailers. Topshop's parent company, Arcadia Group, faced financial difficulties, leading to administration in late 2020. This downturn culminated in the closure of all physical Topshop stores, including the iconic Oxford Street location, marking the end of an era for high street shopping. In a twist of retail fate, online fashion retailer ASOS acquired Topshop, Topman, Miss Selfridge, and Hit brands in February 2021 for £265 million. This acquisition transitioned Topshop into a digital-only brand, aiming to preserve its legacy in the online fashion sphere. ASOS integrated Topshop's offerings into its platform, reaching a global audience and keeping the brand alive in the digital age. Topshop teases high street return amid digital revival, and there you have it, 15 once iconic clothing brands that are either disappearing forever or drastically downsizing. It's crazy how quickly the retail world changes. One minute, we're all rocking our favorite Forever 21 outfits, and the next, it's a ghost town. Some of these brands are making a digital comeback, while others are fading into fashion history. It just goes to show that no brand, no matter how big, is safe from changing trends, online competition, and, let's be real, our collective obsession with fast fashion and convenience. But now, I want to hear from you. Which of these store closures surprised you the most? Did you shop at any of these brands? And which one do you secretly hope makes a comeback? Drop your thoughts in the comments below. I read every single one. If you enjoyed this deep dive into the fashion world, Make sure to hit that like button, seriously, it helps a lot. Subscribe for more eye-opening retail stories, and turn on notifications so you never miss an upload. Thanks for watching, and I'll see you in the next one.